Welcome everybody to our today's webinar about combining a regulated crypto product with a traditional asset. What is the real added value? My name is Sina Meier. I'm responsible for the market of Switzerland at 21 shares. And like most of you, I'm coming from the traditional finance world. I've been working for more than 25 years in finance, and I'm happy to be with you today. I give you a very short schedule about our program today. So first of all, we will introduce quickly our company. Then we will show you what we do. Then we show you also what our people are in the backgrounds. And of course, after we will show you more about why to invest into crypto. And then the big star of today is for sure OpenMetrics with Felix. Welcome, Felix, to our webinar. He will show you all the charts and everything, like what makes sense for a portfolio. And after, we will suggest our solution, and then we will have some time for your questions. Let's do it. Let's do the first slide then, Felix. So 21 shares is a Swiss company. We are in Zug. However, our offices are in Zurich at Brandschenkestrasse. So if some of you would like to say hello, we are physically at Brandschenkestrasse 45 in Zurich. We also have an office in New York City and another one in Berlin. Some key figures maybe about the company, because some of you might even not have heard of us. We are quite big, so we are written here on the slide 120 million asset under management, although in real time now we have 180 million under asset management. We have 11 different ETPs. So ETPs means exchange traded products, which are products who are listed, like the name says, at traditional exchanges. Then the company was issued about 2 years ago. And I tell you quickly the story why our company has even been created. So our two co-founders, Henny and Ophelia, both of them with family offices, you can see them on the screen at the left side, they were looking for a solution for their own families to make a meaningful investment for their own families. And they were checking for quite a while around the world which kind of solutions already exist. And well, after a while, they found like, no, nothing really suits for us because we need something regulated, easy, something which we have still the money under control. So what happened is they launched their own company in 2018 and created 21 shares. 21 shares will stand for 20 million Bitcoins, will be at the maximum ones which are created, which are coded, and that's why our name is 21 shares. Next slide. We have, like I mentioned before, a couple of ETPs available. We will speak mainly about the one in orange at the upper floor, the ABTC, which is the 100% Bitcoin ETP. All of them, like we just said before, are listed on SIX, Deutsche Börse, Wiener Börse, and a couple of other stock exchanges as well. And now we want to see, why do we really want to invest into Bitcoin or into cryptos? And we will ask our miracle or our oracle why we should invest into cryptos. First of all, the store of value or the safe haven. So traditional scarce commodities such as gold and oil or even the US dollar were considered as a hedge against inflation. In times of quantitative easing or COVID packages, Bitcoin is a rock in the surf because nobody can manipulate the total supply of Bitcoin, which is 21 million, what I just said before, which is potentially a hedge against the inflation. The second point is the uncorrelated returns or diversification. Analyses show that cryptos are only slightly correlated with the performance of the stocks and the bonds. In fact, Bitcoin has outperformed just about every major stock index of the last 3 years. The third point, of course, is return. Why crypto assets? You can only profit from the increase in value of assets itself, but you can also achieve an attractive return on selected digital assets such as Tezos through the staking process. We will see shortly in a small allocation in your portfolio will do with your risk and return, so the Sharpe ratio. And who invests in Bitcoin? We can see here on the screen, we have the left-hand side, the millennials, in the middle a Gen X, and then on the right side, the baby boomers. And this slide was created about 1 year ago, and you can clearly see that the millennials, so the future, on top 5, what they invest are the Bitcoins. I suggest, I mean, like, I'm not sure because I cannot prove it with a chart, but I assume that in the last year that Bitcoin could already be something more on the top 3 assets maybe, because it performed so well. And now I hand over to our guest, Felix, who will speak about more the facts and why you should or why you could invest into crypto assets. Welcome, Felix.
Thank you very much. Thank you, Sina, for your kind introduction. Maybe briefly about myself. Felix Fernandez is my name. I'm co-founder and CEO of OpenMetrics Solutions. We are a spin-off from ETH Zurich, founded in 2016. Started our business mainly with advising pension funds and tactical asset allocation, and grown into different areas with regards to index development, product design, etc. And one of these fields where we spent some research in the last 2 years approximately is how to apply meaningful cryptocurrencies, or how to integrate them into an existing portfolio, because typically investors are having a multi-asset portfolio. They're typically not holding just one asset. They're trying to diversify across different asset classes. So the question was a real added value, and for that I will make a quick tour where we're coming from, so that to understand what the rationale is for the results that we will show you. This is one of our key quotes, and the reason for that is that our core belief, if you want, is that you can measure financial markets, but you cannot predict them. And I will elaborate a little bit further in a minute. Briefly about us. So founded in 2016, as I said, we have a role as a solution provider. We help financial market professionals with advanced statistical methods. So we can do all the, let's say, traditional standard methods and some more, which are not yet common in the market, and help with implementing this in financial engineering solutions and or products. And also we work as an academic bridge, so we invest a significant amount of our resources into ongoing research, so that we can ensure that our clients always are having access to the most recent academic developments. In contrast to maybe other providers, our approach or our models are completely transparent. We, if we want, with our heritage as coming from academia, we are, let's say, taking care that basically everything we do is well documented and transparent. So it's not a black box. All the methods and concepts are explained, and we can always explain why the models behave the way they behave. Now, coming a little bit into the, if you want, general concept or how we approach the topic of measuring markets, and you will see in a minute why this is relevant. Well, one step, let's say, more abstract, we talk about systems. So every system consists of a random component, which is typically something you're having in your computer, a random generator, and also there are, let's say, other physical mechanisms which showing random behavior. And they are deterministic systems, so systems which are defined by rules. And within these deterministic systems, you have always a little bit of chaos. So if you want effects that you cannot measure, and effects that may lead in the long run to the so-called butterfly effect, so that small changes in the input parameters lead to large changes in the results if the prediction window is large enough. Stochastic systems, which is basically what we encounter in real life, are always a combination of both. They sometimes have a little bit more from one, sometimes maybe less, but generally they are always a combination of both. And there is a, if you want, systemic view, which is driven by a mathematician called Lyapunov. He was a Russian mathematician who already formulated in 1950 approximately his Lyapunov time, which defines that any physical system, any system in general, has a certain time when you cannot predict basically across this time limit, regardless how good your algorithms are getting, regardless how fast computers are getting. And if you go from right to left, so planetary orbits are predictable for millions of years, but not exceeding that. Why? Because there's always a chaotic component that you cannot fully, let's say, factor in. So even these very stable systems, very deterministic systems, have the physical limits. Whether it's well researched, we talk nowadays about prediction times of 5 to 10 days. And this is the time that you can do meaningful predictions. And it doesn't matter, as I said initially, if the models are getting better or we're getting more data or more computational power, you will not get across this line of 5 to 10 data. 5 to 10 days. If you look at financial markets, this field is probably not that well researched, but financial markets are, let's say, described in terms of more seconds with regard to this Lyapunov time, so the limit where predictions make sense. This means that there are market participants like high frequency traders who can benefit from that. But above that, and this is most investors are dealing with much larger frequencies. So pension funds typically rebalance their portfolio in months, maybe in weeks. Funds typically weeks or days. So everything is basically much slower than the potential prediction time. And this is basically the reason why we are not rich yet. Because the more drivers such a system has, the more random it is, and the shorter is the possible prediction time. So what we focus on is to measure the current state of the market as precisely as possible, and then having a consistent and well-structured process to manage the exposure of the according asset/portfolio. So in a nutshell, instead of finding a crystal ball or the holy grail, we propose instead a sensor system which is just faster and more accurate than traditional sensors. A little bit more technical in this regard is, and also that you understand what our approach to financial markets is when we look at financial markets, there is a model which is, let's say, well accepted in academia, that you are talking about phases. Some you may call it regimes, you can call it dynamic. So there are phases where the market has a certain dynamic, then there is a transition phase, and there is a new dynamic. Here it's simplified with risk on, transition period, risk off. Now, that means that you cannot just work with one assumption, one stable distribution across time. Your models have to adjust to the regime changes. And this is basically what we do with our methodology. We use, therefore, it's called Bayesian change point method, which can deal with not only with non-normal distribution, it's also quite faster than traditional methods. And you see here in the middle chart, when you see the trend, there will be green bars which are moving from a positive trend, and there is a transition phase, and then there is a negative trend. You see that this orange-brown line is relatively slow in the way it changes. With including the structural break information, and this is this yellowish bars that you can see, these are basically the core component of our sensor system. So they detect we are entering a new regime, and then the model adjusts to that and can speed up, if you want, the adaptation. And it's self-calibrating, so you don't need any parameters, you don't have to train the model. It works as it is across all asset classes, so we use the same model for cryptos as we use it for equity, for bonds, etc. In practice, this looks like this. So this is a, basically a heat map where we basically adopted a color, a traffic light coloring approach. So red is full stop, green is go ahead, and yellow is basically be careful. And let's say the colors in between, or the numbers in between, tell you what the exposure is. And this is a typical pension fund portfolio, where pension funds are having exposure in equity, in bonds, commodities, real estate, have some currency dependencies, and so forth. And this is what is basically the working basis for that. Now, the main point, or the main question today was, what happens if we are adding, let's say, Bitcoin, like in format like the 21 shares product, as an ETP to our portfolio? Now, we take here a very simple approach. We just assume that our investor has global equity, or is invested in global equity alone. Let's just turn the light on here. And you see this is the blue line. So this is the MSCI World in US dollar. You see an annualized return of 10%, a volatility of 15%, and the maximum drawdowns, which are around 30% for this time window. Now, if you add 4% of Bitcoin into this portfolio, so you reduce your equity exposure to 96 and add 4% cryptos to it, or Bitcoin in this case, you see that the risk profile is not changing. So you have approximately the same drawdowns. This is the middle chart. You have approximately the same volatility. You have this, as a main difference, 50% higher return. And this is, if you want, the pure benefit of that. This sample is calculated on a weekly rebalancing basis, but the effects are very similar if you do it, for example, on a monthly basis. But important is that you, of course, keep always this portfolio ratio constant. So this is a sample for a constant portfolio ratio. This is what everyone can do. So if you buy today a Bitcoin ETP from 21 shares, you can add it to your portfolio and create this added value out of the box. So there's no more required than that. Of course, this is where we are bringing our added value. You can do better. And the question is how? And this is when you apply, and this is why I elaborated on how to measure market dynamics and market stability, is when we apply such a risk control, so a dynamic model, into the next model, which is you can see here. And the first main visual difference is when you look at the bottom, you see this waterfall chart. What you see is that we have different components which are not having a static weight, they're having a dynamic weight, which changes over time. This is a rolling window. It's basically the same way you would run a portfolio in practice, and you run in practice. We have gone one level further down here. So this portfolio consists not of the MSCI World raw. Instead, it consists of the 6 underlying regions: North America, Europe, Pacific, and emerging markets, etc. It contains then up to 10% Bitcoin. And then during times where you are not fully allocated, so that you are not invested in equity and or Bitcoin, you have to keep the money in another pocket. And here we keep it in what we call base portfolio, which is a dynamically controlled blend of bonds and precious metals. The reason for that is that nowadays you are not getting any interest rate for cash. So it doesn't make sense to keep a large amount of cash of your portfolio for a longer period. Now, if you look now at the chart, and we start with the top chart here, you see that the distance between the blue and the green line is higher. So the green line is the dynamic hedge. And you see that now the annualized return is roughly 2 times the value of the MSCI World. The volatility is reduced, and this leads to, of course, a higher Sharpe ratio. And in terms of capital protection, the maximum drawdowns are reduced roughly by 1/3. This is a very typical value. Typically with such concepts, you can reduce your drawdowns by 1/3, maybe 50%, sometimes even a bit more. What is the message here? The message is that if you add a, let's say, risk control model on top, you can even improve the results and create a higher value for your portfolio. And to finalize, or to basically put this all into perspective, it's always a good view to look at the risk-return profiles, so that you can see on the horizontal axis, in this case, we define risk as volatility. So this is basically a very common view. And then the vertical axis is annualized return. And what you want to have is a good balance between both. So good annualized returns, but also low volatility. And you see here that on the right-hand side, the black name here, MSCI, is basically the index, the equity index. And you see the figures here in this matrix. And then it moves basically higher up, which is good. So as stated before, just adding cryptos to traditional assets, so in this case equity, just improves return without any ado. So it really works well. And if you go one step further, you not only increase the returns again, you're also reducing the risks. And this is basically from my side. If you have any questions, happy if you can contact Sina or us. Yeah, that's it from my point.
Thank you very much, Felix. Well, of course, I will now also show you our solution which we have for your portfolio. And this is the 21 shares Bitcoin ETP, the ticker ABTC, which exists in US dollars, euros, Swiss francs, and pounds. And well, a very good question is also, why our ETPs? Well, investors can benefit from added value. And that's clearly the first-class product structure. It offers private and institutional investors one of the easiest, most secure and liquid ways to invest into the crypto assets, like I just mentioned you before, why our company was created. The liquidity is supported by first-class market makers. These liquidity providers manage the otherwise fragmented liquidity in the Bitcoin market. Our ETPs are backed 100% with physical cryptos all the time. The cryptos are held with regulated and insured custodians in order to reduce the issuer risk, which is not the case with most other financial products using cryptos. We also use an independent trustee for additional investor protection. This said, maybe we should also tell you why we cooperate in this webinar together. It's clearly because 21 shares only works together with the best experts. And of course, OpenMetrics is a known name. It's a spin-off of the ETH in Zurich, like we just said. So we thought, yeah, let's organize a webinar where someone else will clearly show you what's the added value or not. And like Felix just mentioned before, of course, it's the added value. We probably knew that from the beginning, but someone proved it from outside, which is very nice. But maybe I would say, like Felix, we are ready for some questions. You can write that in the chat if you have a question. We can go to the next slide. And maybe I already have one question for myself, because I hear this a lot from the clients, Felix, and I think you would be the good person who can answer this question. So what's the correlation of Bitcoin and gold? Because I hear this all the time, like almost on a daily basis. Can you maybe tell me what's the correlation of Bitcoin and gold before we go to other questions?
Yeah, I see that. I saw that coming. So I have prepared an analysis for that. So just to give you a visual interpretation. So what we compared here is Bitcoin across the life cycle, and then basically compared with gold. And what you can observe here, so the red line is gold, the black line is Bitcoin. And even in this, let's say, correct logarithmic representation, you can see very clearly that Bitcoin has, of course, outperformed for quite a while gold as an asset. So in order to look at the correlation, we always look at two dimensions. So first, what is the relative performance? This is what you can see here. So basically, the extreme performance is also due to the extreme volatility, which means that these moves are, of course, if you want volatility-wise, in another league or another range. But this does not matter for correlation. There is always a misconception a little bit that trend or dimension or price has something to do with correlation. This is not the case. What is relevant for correlation is how the returns behave. So by looking at if you want static or average correlation, so if you look at this window, so the full window, we have a correlation of roughly 0.08, which is basically 0. And you see this visual representation where you see these many blue dots, which are forming like a bubble. So this is a very good visual representation that they're not having any correlation to each other. Otherwise, you would see anything like a line or any type of let's say, correlation and regression line we can draw from it. What is also interesting, because this does not tell you anything about the changes over time, is the rolling correlation. And the rolling correlation is therefore interesting because you see that correlation is not stable by no means. So you see that historically it has been moving quite hefty around 0. So sometimes it's closer to 0.5 and sometimes it's closer to minus 0.5. However, there is a certain observation, and we have to see whether this is stable or not, is that when you look at the right-hand side, so from January onwards, so January 2020 onwards, the correlation seems to increase more and more and staying around 0.5. There is already some market opinion about that. I don't want to speculate. The only thing is what we can really measure and detect is this effect. And this is basically telling you that gold and Bitcoin are basically having the same correlation patterns in a way that their returns are moving in a similar fashion.
Thank you, Felix. We have some other questions. One other question, where can we buy the 21 shares products? Can we buy it at 21 shares? No, we are not a store. We are just an issuer of products. So you can find our products. Most of the banks in Switzerland, they have it. Also other banks, of course, or brokers. You can. It's that easy like a stock. It's an ISIN number. You go to your portfolio where you have your account already now. No need to open a new account, and you buy the product or you sell the product. It's very simple, very easy. Everybody can buy it. So it's not with 21 shares. It is with your own account where you put the ISIN number like a stock. Then another question we have, this is for you, Felix. How big should be the part of crypto in the portfolio? 10% or more?
Well, I think more than 10% is probably a little bit aggressive. Of course, you can do everything you want, but from what we have tested in, let's say, in a context or based on our experience, what investors are willing to accept in a multi-asset portfolio, where you are typically looking for, let's say, a certain protection, is that you want to avoid a too high concentration into either one asset or an asset class. So the old saying, don't put all your eggs in one basket. So to answer your question, from our experience, if you are adding a fixed proportion, so if you are not using any kind of risk management on top, also called tactical asset allocation, anything between 1% and 5% is reasonable. You can go above that, but then typically the impacts are getting higher and higher. And the reason for that is that the volatility of cryptos in general and Bitcoin in special are roughly 10 times those of equity. So it fits well. So basically what you do with maximum 10% is that you are keeping the Bitcoin proportion within a range that makes sense, also compatibility of others, so that Bitcoin is not dominating your portfolio. So for me, 10% would be absolute maximum if you're using a dynamic approach. And for the fixed approach, anything around 5% should be fine.
What we say, maybe from 21 shares, if I'm seeing a client, then we are always saying between, I mean, it depends on the risk appetite, of course, but we say between 0.5% for someone who has a really big portfolio until maybe maximum 5%. But this is not up to us to decide. It depends on the risk appetite. Then I have a couple of other questions. One other question is there a minimum amount? No, there is no minimum amount. 1 minute for our ETPs, it is just 1 unit, which depends how big it is. It could be 50 Swiss francs, so it could be 100, depends on which ETP you're buying. And also a question about, can we have the slides later on? Yes, we will send you all the slides if you would like to have the slides. Then another question, are you listed or planning to list in the US? Well, this is maybe for me, and again, a question. Yes, we have now at the moment, like we said, we're covering the whole DACH region, so Germany, Switzerland, and Austria, but we are also in Sweden, and we are planning with our master plan to go from one stock market to the other one, that we can list to the exchanges, different exchanges, sorry. And it is also in our how you say that, in our structure, that we would like to go to the US at one point. We're not there yet, because as you know, in the US there are different products available because of regulations. But yes, we are planning, but maybe it's not the first priority, the US, because it's always a little bit tricky with the US. Then again, a question, hi, for Felix. Do you know the production price of miners, the average?
To be honest, no, I don't have it on top of my head, because this changes a little bit. It depends on mainly energy costs, and if they are subsidized, it depends on where you are sitting. I would have to research this myself, sorry.
I will, the person who said that, I can clarify this, and I will come back to you after the webinar and send you a personalized message. Then maybe the last one is, yes, we have we have a research team, like you probably just saw in, we have an excellent research team at 21 shares, and we have also newsletters, and we have also a State of Crypto magazine in different languages, German, English, Italian, and French, for the French-speaking people. Which you can ask me and I will send it to you with pleasure. And also a newsletter, I can put you on the VIP list. So just send me a text, you have my contact details, and I will add you on this list. And last question, maybe before we start, I think like more questions coming in now. Do you think climate change could have an impact on Bitcoin? Felix? Do you have an opinion on that? Maybe massive use of energy.
I don't think that there is necessarily a conclusion that you can draw, because basically, let's say my first assumption would be, what are the effects of, let's say, producing cryptocurrencies with, let's say, effects in climate change, or what are affecting climates, which is probably just the carbon footprint of energy plants. Well, if you have, let's say, many crypto farms in countries where, let's say, the energy is produced via coal, then it's probably, yeah, it could have an impact. I don't know if this impact is big enough in, let's say, in the larger context of other industries, that it would make a significant difference. But again, this is maybe a very special topic that needs some own research in order to draw, yeah, meaningful conclusions out of it.
I will come back to the person after the webinar and answer the question privately, so the person can have a very good research piece about this, because we have, like I said, a great research team we have discovered, but this will be a completely different subject than what we are discussing now. I think if there are no further questions, I think we close it here. Thank you very much for your attention. that you were with us today for this webinar. Thank you very much, Felix, for your expertise and for your nice presentation. It was very insightful, also for 21 shares. And please, again, last word, do not hesitate if you have any questions later after this webinar. Either it's going back to Felix about the whole setup for OpenMetrics, or if it's about our ETPs or other subjects you would like to discuss about Bitcoin, about cryptos. We are the experts on this field. Thank you very much for your attention, and I hope we will see you very, very soon again. Bye-bye.
Thank you very much.